All right, let's get right into it. Today, we're going to tackle one of the biggest, most misunderstood questions in all of investing. What is the real relationship between risk and reward? You know, getting this wrong could literally be the costliest financial mistake you ever make. So let's make this super real with a story that might hit close to home. First, you've got Priya. For 25 years, her dad did the safe thing. He put his money in fixed deposits because, he was terrified of the stock market. His 1 lakh turned into 2.5 lakh. Okay, now meet her colleague Amit. His dad invested the exact same amount for the exact same time, but he put it in a simple Nifty 50 index fund. And his final portfolio? A whopping 19 lakh rupees. Think about that. Same money, same time, but wildly different result. That gap, that 16.5 lakh rupees, that's not just a number on a screen. That is the hidden cost of playing it safe. It's the price you pay for a mistake that comes not from taking risks, but from avoiding the right kind of risks. And that is the core of what we're going to break down today. Okay, so here's our game plan. First, we're going to unpack that hidden cost of safety that affects so many people. Then, we'll totally redefine what risk really is. I'll even show you the #1 tool to manage it. And finally, we'll make it all about you, figuring out your own risk profile and building a simple plan to take control starting right now. All right, first up, the hidden cost of safety. Look, this isn't just about Priya. This is a massive nationwide issue. We're talking about why a staggering 90% of Indians are missing out on real wealth creation, even though they know the stock market exists. And this right here, this is the heart of the problem. See, it's not that people don't know. It's that they don't act. SEBI data is super clear. Tons of Indians are aware of the market, but over 90% are just sitting on the sidelines. And why is that? Well, it all comes down to a fundamental misunderstanding of risk. And believe me, that misunderstanding is costing them big time.
Okay, check this out. This table shows the silent killer that's behind all that fear, inflation. Let's just walk through the numbers. A bank FD might give you, say, 7%. Great, but after tax, that's already down to 4.9%. Now here's the kicker. After you factor in 6% inflation, you're actually losing 1.1% of your money's value every single year. Your money is literally shrinking. Meanwhile, that risky equity fund, even after taxes, it's growing your wealth by a real 6.5%. Just let that sink in. The safe option is actually a guaranteed way to lose money. That is the real risk we should be talking about.
So wait a minute. If the safest choice guarantees you lose money, then we have to completely redefine what risk even means, right? It's not just about the stock market going up and down. The real risk, the one we should all be worried about, is inflation silently eating away at our savings. So here's the bottom line. There's no secret, magical, safe investment that's going to crush inflation. It just doesn't exist. The risk-return relationship is like a law of physics in finance. You want the chance for higher returns, you absolutely have to accept a bit more risk. The whole game isn't about avoiding risk. That's impossible. It's about understanding it and managing it smartly. And hey, don't just take my word for it. The National Institute of Securities Markets puts it perfectly. To beat inflation, you have to pick your poison, so to speak. You either take on the risk of price swings in the market, or the risk that a company won't pay back its loan, or the risk that you can't sell something fast. If you try to avoid all of those, you're actually choosing the fourth, and maybe the worst risk, the absolute certainty that inflation will destroy your savings. Okay, so let's break down the actual risks you'll face, because, understanding what you're up against is the first step to winning. We're going to focus on two big categories: systematic and unsystematic risk. So this is what everyone's scared of, right? The volatility. Just look at the Nifty 50's wild ride recently. We had a huge run-up in 2021, then a down year in 2022 when interest rates went crazy, and then another strong bounce back. Yeah, the swings are real. They can definitely be nerve-wracking. But here's the most important part. For investors who just hang in there, the long-term trend is up. That volatility, that's just the price of admission for getting those higher returns. But hold on, risk isn't just a stock market thing. So many safe investors learned this the hard way back in 2022. When the RBI started hiking interest rates, these safe, long-duration debt funds, mutual funds that just buy bonds, suddenly dropped by 8 to 10%. It was a huge shock to people who thought debt meant zero risk. It's a perfect reminder that hidden risks can be lurking anywhere. And this brings us to a really, really important idea. There are two types of risk. Systematic risk affects everyone. It's like a recession or a change in interest rates. Then there's unsystematic risk, which is specific to one company, like a bad product launch. The best way to think about it is this. Systematic risk is the ocean tide that lifts or lowers all the boats. Unsystematic risk is a leak in just one of those boats. You can't control the tide, but you can definitely patch the leak. And knowing that difference is absolutely key to building a strong portfolio. So we've got one kind of risk we're stuck with, but another one that we can pretty much eliminate. So how do we do that? With the single most powerful tool any investor has, diversification. I mean, look at this. It perfectly shows the magic of not putting all your eggs in one basket. If you only own one stock, everything depends on that one company. But look what happens when you start adding more stocks. The damage any single company can do gets smaller and smaller. Your overall portfolio risk just plummets, even though you're still invested in stock. And how much risk are we talking about getting rid of? About 90%. Yeah. Just by owning 15 to 20 different stocks in different industries, you can wipe out almost all of that company-specific risk. It is the closest thing you will ever get to a free lunch in the world of investing. Okay, so now that you get the different kinds of risk and how to deal with them, the next big step is to understand, well, yourself. What is your personal risk profile? And trust me, it's way more than just some score on a quiz. To really figure this out, you've got to look at it from 3 angles. First, there's your financial capacity. Like, can you actually afford to lose money right now without it wrecking your life? Second is your time horizon. Are you saving for something 20 years away or 2 years away? The more time you have, the more risk you can handle. And third, and this one might be the most important, is your emotional capacity. So let's just do a quick gut check. No theory, just be brutally honest with yourself. You wake up tomorrow and your portfolio has dropped 25% overnight. What do you actually do? Do you hit the panic button and sell everything? Do you just kind of hold on for dear life? Or do you see it as a chance to buy more? That answer, your honest gut reaction, tells you everything you need to know about your real emotional tolerance for risk. And listen to this. It's a real story from an investor that is such a powerful lesson. This person thought they were a high-risk investor right up until the market crashed in March 2020. They totally panicked, sold everything at the very bottom, and then had to watch as the market soared back 140%. They learned the hard way that what you think you'll do and what you actually do in a panic are 2 very different things. It's a huge reminder to be realistic about our own emotions. Okay, let's pull all of this together. We've talked theory, we've talked risk, we've talked psychology. Now it's time to make it real. Let's turn all this knowledge into some simple, concrete steps you can take this week. So here is your 7-day action plan. For day 1 and 2, just calculate your current mix of stocks versus debt. Just get the basic numbers. Days 3 and 4 are for thinking. Be honest and assess your financial and emotional capacity based on what we just talked about. Then on days 5 and 6, go on a hunt for concentration risk. Do you have way too much money in one stock or one sector? And finally, on day 7, you create a simple plan to get your portfolio back in line with your real risk profile. And really, that brings us to the final takeaway here. Smart investing is not about avoiding risk, it's about understanding it. It's about managing it. It's about making sure the risks you do take are the right ones for you. It's all about turning that fear into a smart, calculated strategy. So the real question is, are you ready to stop being afraid and start truly understanding the risk in your portfolio? And just a quick but really important reminder before we wrap up, this is all for educational purposes. Investing always has its risks, so for advice that's tailored specifically to you, please talk to a CB-registered investment advisor. And hey, if you want to get a head start on that 7-day plan and get a better handle on your portfolio's risk, you can check out tools like Tradeoff. Thanks so much for joining.